But the biggest difference between bonds and high yield savings account or money markets or CDs, any of those short term vehicles, is just interest rate risk. So when yields rise, that is great for short term liquidity like a high yield savings account because you don't lose any money and your yields adjust fairly quickly. In a rising rate environment, cash like accounts like this are great because you get higher yields and there's no price reaction. Bonds have inverse relationship to yields. Yields rise, bond prices fall. That's what we saw this decade. When yields went up, bonds got crushed. But the opposite is true in a falling rate environment. If we go into recession or simply a period of disinflation, bonds should do well as rates fall. But a high yield savings account will only experience the falling yields. You don't get a burst in price in your high yield savings account, right? When yields fall. Let's say high yield savings account yields go to 2.5% or something in a recession, and bond yields are at 4. Bond yields would probably fall too in that situation. But intermediate term 10, 7-year bonds should be higher than high yield savings accounts in a more normalized environment. You don't get that boost, and now you're sitting on lower yields. The way that I look at it is there's a place in portfolios for both bonds and high yield savings account. High yield savings accounts are great for liquidity. It's really easy to move your money around. You don't have to make any sales. You just hit a button and it sends your money to your bank account. So for short-term savings, spending needs, high yield savings account is great. I have one. I use it all the time. I put my money I have to pay for quarterly taxes in there. I put our vacation fund in there, all that stuff. Bonds are a great hedge against stock market volatility, deflation, and recessions because, again, you get that bump when yields fall and bonds go up. And bonds should eventually have higher yields than high yield savings accounts. If you've been sitting out and parking T-bills in high yield savings account for a few years and you're earning higher yields than bonds, going, who are these suckers sitting in bonds? Like, that's not going to last forever. It shouldn't last forever.